Hi, everyone, and welcome to ECommerce webinar, Key Insights from the 2020 True Cost of Financial Crime Compliance Study, sponsored by LexisNexis Risk Solutions. My name is Ana Aguilera, your host for this webinar. I will go over a few housekeeping items before turning the program over to our speaker. Our webinars are enhanced by your participation, so we do encourage our attendees to send your questions by clicking on the Q&A icon on the bottom of your screen. Attendees will receive 1 CAMS credit for this webinar, so long as the webinar is watched to completion. Webinar progress and completion is tracked based on the time the webinar window is actively engaged. If you experience any issues during the webcast, hover over to the bottom of your Zoom meeting screen to make the meeting toolbar visible. If the far left icon is a handset labeled Join Audio, then you have not yet connected your audio. Click on the Join Audio headset icon and select the Join by Computer Audio tab to join your audio. When your audio has been connected, the far left icon will change to a handset labeled mute. As a quick reminder, a recording of today's session will be made available for viewing by end of day. Just navigate back to the webinar launch page and you'll be able to launch the recording. You will also be able to download a copy of the slides through that same page. Today, we will be utilizing polling questions for this webinar. For best functionality, it is advisable to download the Zoom application when joining by browser. You will not be able to respond to the polls otherwise. And thank you, everyone. With this, I am very pleased to welcome our speaker for today, Daniel Wager. Daniel Wager is an experienced financial crime compliance and investigations executive with extensive experience in developing and running programs designed to prevent, detect, and report money laundering, sanctions violations, arms proliferation, and other crimes. A respected expert witness in civil and criminal litigation, he is a trusted authority in interactions with regulators and enforcement agencies. In his current position, he assists regulated and non-regulated entities in avoiding legal, regulatory, and reputational risk while protecting the global financial system from illicit fund flows. He joined LexisNexis Risk Solutions in 2016 from a long and meritorious career fighting financial crime. With this, I'm very pleased to welcome Daniel. Welcome, whenever you're ready.
Thanks, Anna. I think I heard an echo there. Let's see if that continues. Thank you to everyone for suffering through that biography. I'm sorry. I would promise I'll abbreviate that next time. Every time I cut it down, it gets snuck back in again, and I'm sure everyone's fairly tired of hearing it. But the bottom line is I've been fortunate to be in a number of different places in the industry and learn from a lot of fantastic people, some of whom are actually on the call. So just a quick shout out to everyone who has taken time to join us today. We have a really large audience, and I feel very privileged to speak to you all. Just a quick note on the industry. It's been a bit of a tumultuous time between the effects of COVID, which we'll discuss today, and recent news related to suspicious activity reporting and other issues around the globe certainly have created some weariness in the industry. But I wanted to just clarify to everyone that just to take a step back and look at where we are. And we've got some people on the phone that were some real pioneers in this space and have been working at this for more than 2 decades. And there's some folks who are newer. But what we can say when you look at the industry right now is that despite any news you might hear or concerns that might be raised, we have a strong cadre of people that are interested in this space for the right reasons, that are reporting activities for the good of the citizens of the world, and that we're having real effects. Human trafficking has received increasing focus every year over year. It's amazing to see how many people are actively involved in looking to combat that horrific crime. Fights against kleptocracy, embezzlement, and illicit activities on that scale have been increasing. The attention to it, while the news continues to highlight the activities, it's been a bit little noticed that the enforcement has been fantastic over the last decade. And we're actually achieving things. Just bear in mind, the reports you create, the actions you take, the investigations you pursue have a real effect on fighting the crimes that plague our world, that run counter to financial transparency and access to the financial system for people that deserve it. So I just want to commend you all. Thank you all for taking time today. Thank you for taking an hour out of your day to join us. And just please, just remember that that's the core of all this. The reason the whole business exists was to identify illicit activity, and you're doing a fantastic job of that. And I would really applaud you for that. So if we could move on in. So I see you've already moved on to the slide there. Today we're going to talk about the true cost of financial crime compliance. And some of you have joined us in the past for readout on this study. We also have a global study and some studies that are done regionally around the world over the course of the year. This study has actually evolved quite a bit in the 4+ years that I've been here. As we've worked with an outside firm to conduct a study and identify trends related to cost, very specifically. And then each year we've added some thematic elements. This year we focused on COVID. But the focus, as you'll see on this screen, is to help individuals in the industry understand the costs and ways to mitigate those costs, ways to leverage people, processes, technology, or just shared insights. And that's one thing I know we've all missed, is just the ability to get together and talk to one another to share those insights. So please continue to do that virtually as we can to share these, because we really gain a lot every time we come together. So today I'll focus on giving you some insight into those drivers of cost, the effects of cost, et cetera. The methodology, you can stay on this page, Anna. The methodology of this study, just to quickly outline it, is that we did a phone collection using an outside firm during August 2020. We reached out to decision makers, individuals who have oversight over financial crime programs or financial crime compliance operations and technology, in order to ask them a set of standardized questions about costs, impacts, burdens. The questions were focused on KYC and AML. We asked banks, we asked investment firms, we asked asset management firms and insurance firms. And we segmented the study into 2 large tranches, 10 billion and under, which we categorize here as small, and mid and large institutions, which are 10 billion and up, and we categorize here as the mid and large, as one group. So we'll break it down in along those asset classes. And again, just bear in mind that this is not meant to be a deep study of every aspect of cost in the industry. It is to really focus on directionality. Do we continue to see more burden? Do we continue to see more spend? What are the effects of those spendings and burdens upon our staff, the processes, and the outcomes of the Bank Secrecy Act reporting system and the financial crime, counter financial crime efforts? So going ahead, Anna, if we could. If we go to slide 7, which we see here, some key findings, just to read through them quickly. One thing that we saw, which I guess is not that big a shocker, is that the costs have gone up. But the thing that surprised me is that it went up sharply. We've seen a significant increase year over year. And I know that many of your institutions are under very tight cost constraints, budgetary constraints around your programs. Despite that, it seems like costs continue to rise, and we'll talk about some of the drivers of that. One, obviously, is a focus around COVID, the effects of COVID, and that seems closely tied to one of the drivers that we see, and that's labor cost. Labor actually jumped significantly year over year, and we'll talk more in detail about that, because there's definitely an interrelation between the COVID impact and the sharp increase in labor cost. We also found that challenges for screening, risk profiling, due diligence, there are still issues. They still affect us during COVID. What's interesting is that for a lot of our responding entities, these have actually become heightened. Every single one of them highlighted that these were areas where there was change in process, performance, or burden. But it also, it was interesting to learn that even with decreased activities in some areas, they seem to have been made up by increased activities in others. Anecdotally, as we talk to people in the industry, one thing that's kind of interesting as we highlight this, yes, global financial activity, investments, travel, vacation spends, consumer spend, a lot of these things may be down. But what's interesting is compliance burden, as measured by the impact of opening a single account for a new entity, seems to have actually risen. The total cost burden of those activities have risen, and it could be we'll detail this some more later. It could be just simply that many people went to banking channels to conduct activities they'd never done before. They're buying things online. They're opening bank accounts, lending accounts, and credit accounts online. Individuals who previously did all of their financial activity through money services, businesses, and others may have moved to open DDA accounts in order to receive government benefits or negotiate benefit checks. So it's a very interesting climate, and we'll dig more into that. Definitely number 4 is one that I really want everyone to focus on, because this has kind of been a running theme for a long time in our industry, but it's definitely becoming more acute as the costs continue to rise. If you're not looking to see how your financial crime processes can benefit the larger organization, you're probably missing out on a value proposition that could bolster your program. If you want to grow a program right now, compliance as a cost center is not necessarily the best avenue. But what we're going to talk about is that, again, we find that compliance, financial crime compliance processes are highly complementary and additive to the overall knowledge an entity has of its customers and how they behave and how better to serve them and therefore to make more money. So we'll talk about that. And then finally, the last one, technologies. This is always one of our continual findings, nothing shocking here. Investing in the right technology, the right data sources, the right processes definitely reduces the rise of cost. It reduces the total cost, but it has to be the right things. And that's the tricky thing in this industry, is finding places where the right things exist, right data, the right processes. What we saw, again, anecdotally in the industry, is that as COVID broke, there was an all-out panic to implement upfront different CIP and onboarding day 2 processes to verify identities, to be able to do it on a mass scale through channels which banks or entities had not operated before. They also found that there were folks that realized it'd be far more efficient if we mix certain processes, whether watch list screening and onboarding or EDD processes together across fraud and broader financial crime. But they definitely have found that putting the right technologies against it helps. We've seen multiple entities in the industry who said, we can no longer do a process to vet businesses as part of underwriting and onward to investigations and regulatory reporting without automating that process. We cannot put fingers on a keyboard because we're processing 15,000 PPP loans. So that's an immediate driver of activity. I spoke to a bank last week that had 50% of their total loan volume was non-customers and 50% was customers, and they have a very big customer base. So a lot of need there to do processes differently. So let's go ahead, Anna. And now I'm going to start moving a little more quickly through some of the detail screens. If we can go on to slide 8. So the first finding that we're going to detail is about the cost of crime, cost of financial crime, sharply up over 2019, as I mentioned earlier, with a big focus on cost of labor. The average cost per org, which is up 55% in many of our reporting orgs, and we'll talk about that. The costs associated with labor, particularly in the U.S., showed a sharp increase. So let's go ahead and go on to the next slide, on slide 9. We'll break down some of these findings and assumptions here. So what we did was, you'll see we broke down Canada and the U.S. here. We normalized it into U.S. dollars, and we showed year-over-year activities. The dark bars are 2019, the lighter blue are 2020, and the ones anywhere in the study where we highlight with a red triangle indicates a significant directional change. So what you see here is on the left, Canadian institutions from 14 to 19.5, a 39% increase from 2019 to 2020 in their estimated financial crime compliance costs. On the right for the U.S., it's up 43% from 14.3 to $20.5 million. So this is, again, like some of you say, oh my gosh, I spend tons more than that. You'll see down below, it's broken down by mid and large, right, and asset management firms, so that you can see some different spends there. The one that shocked me here was the asset management firm costs, particularly because of the lower volume of operating in a non-retail environment. But again, I think that COVID probably had a large impact to that sector as people liquidated, repositioned securities holdings and investments. So a lot of activity there. The bottom line is it's going up year over year. So let's go to the next page, Anna. On page 10, again, we'll stay to page 10 if we could, please. Yep. On page 10, the labor cost portion is what we talked about as a major driver. You can see there on the Canada side, labor from 52 to 58%, right? On the US, it's 54 to 60%. So what that means is that in 1 year, the share of labor burden for total cost increased by a statistically significant percentage of 6% on each side of the border. So what we highlighted, because this was a part of the responses, both directly in the study and anecdotally outside it to verify labor costs, extra labor costs. And we started asking people why. And they said, well, you know, in the difficulties of hiring and onboarding new people, many of our places were asked to perform more work on more time. People working at home were given flexible hours, but given the opportunity to work more. We rewarded staff, whether salaried or hourly, with extra compensation in order to perform this extra work in the tight time frames needed. Again, whether it was onboarding new customers, opening new accounts, or processing PPP loans, we had one institution that said, yeah, we had a hard enough time getting our hands on hundreds of laptops. The thought of hiring a bunch of 100 more was just not possible. So we asked the people that we already had in place to just work more, and they were happy to do it because they'd wake up at 5 and work till 8, take a break to get the kids to school, work a few more hours, work again in the afternoon and again in the evening. And what we found, shockingly, is that their productivity was even better. We heard that from a number of responses. So just a key thought here is, in your organization, after the blip of a move to remote work, did you actually see productivity and effectiveness, possibly even accuracy, go up? That's not part of our study here, but you'll see some more details on it in a bit. Think about it, because it's going to be key to decide what we regress to, what's the state we return to. But labor is definitely up. It's almost like a remediation year for the whole industry. It's like everybody was putting a look back. So if we can go ahead, Anna, to the next one, we'll start covering some finding number 2 information, and then I'll pause after that one and take a look at some of the questions that we have in Q&A. Feel free to use the question and answer function in the Zoom browser or in the Zoom app in order to put a question in. And if we can't answer it right now, we'll take it away and we'll get back to you later. So on key finding number 2, shocker, COVID impacted costs significantly. We knew this was going to be a factor, we just didn't know how. And early on, it was interesting, the first couple months of full lockdown, we saw volumes of inquiries, volumes of screening, sizes of batches drop significantly for a brief period. Couple weeks of significant drop-off in fraud and financial crime and other areas across the industry. And then it began to fire back up and has stayed back up. We don't know what would have happened if we continued without COVID, but we know that what quickly happened was the industry adapted to the new working space, but it came at cost. So we believe also that because this survey was conducted in August, we're going to see continued COVID cost impact, and some of those costs may have been underreported by respondents. We definitely know that the impact of COVID on KYC and due diligence processes was quite severe. Delays in onboarding, delays in processing loans. If you look at the fraud cases evidenced from PPP prosecution so far, what you'll find is repeated references to individuals opening multiple loans. What's intriguing about that is, as we asked the industry about that, people said, well, it wasn't unusual. We would find people that came to us after going to 3 other lenders and go to 2 more after us. They were trying to find someone that could process them first. Interestingly, the federal government processed them all. So a lot of people ended up with multiple issuances, multiple loans, which you have to wonder how the impact on fraud there. So if we go ahead, Anna, to the next page, we'll talk a little bit about COVID in detail here. Again, it might actually be higher. We think it may continue trending upward as people assess and capture the full cost. But right off the bat, In Canada, 34% of the increased costs, which we talked about in finding number one, they attributed to COVID. In the US, mid and large institutions said 23% of their increased costs. Again, it might be underassessed. COVID may actually be driving a bigger portion of that cost increase. But as you look at the breakdown of the cost increases for the US and Canada, mid and large institution respondents, the distribution cost is right there down the center, 35% labor in Canada, 31% labor on the US side. And I won't read each of the other ones off, but the big, no huge deltas there between the two countries of note, except perhaps technology. I do find it interesting that compliance technology in the US from our respondents was attributed as having a bigger share of the surge in total costs. Now, as I mentioned earlier, we have had a lot of insight in the industry where people rushed to implement solutions in the face of new account openings and PPP loans, et cetera, or a new channel going online when most of it was face-to-face and your branches are now closed. So the question there is, was Canada in a better space from a technology standpoint? Were they already operating in an environment where there was more online channel? It might be the case. Having worked for a fantastic cross-border institution before, I can tell you that there was definitely a very ardent focus on online as a channel. So perhaps Canada was better prepared to avoid sudden costs from COVID-19 about changing of channels and online interactions, but we'll have to prove that out with some more discussion. Just note, the lesson for you all to take away, you discussed this, is to say directionally, costs are up year over year. COVID is a big chunk of that, but labor is the space in both the US and Canada where we see the biggest increase in costs. Labor. We're still throwing people at problems. Perhaps we'll always need to. The question is, should we be getting to a space where we need fewer bodies because our data internally and vendor provided, our systems, internal and vendor provided, are giving us information to reduce manual processes and allow these highly paid individuals to make decisions? I don't think we've gone far enough in the industry yet. I don't think this is a strange view. I think a lot of people share it. It's probably not very shocking. But what's shocking to me is that there are still people out there who are pulling data to do due diligence or investigative processes by requesting it in an email to some other department, by manually manipulating spreadsheets of piped delimited data. That is not a good process. So you might want to take a pause in the next few months to the betterment of the outcome of your compliance program's budget to turn and say, where did we experience the most pain? Where were the cost burdens the worst? How do we avoid that and bring a better customer experience and better financial outcomes for the bank, the investment firm, the credit union, the money services business? How do we do that? I would suggest, folks, that now is the time, because as entities begin to redo budgets, and they will be redoing them again in the early part of the year, because that budget they made middle of this year isn't holding. You'd be in really good position to go back and say, what we've learned is that people didn't work here, we should automate, or this part here was automated, but it wasn't the right tool. Take a look, find ways to get ahead of this curve, because unfortunately, I don't think this is going to be the last time we have this kind of disruption, and we don't know how long this one is going to persist. So if we could go ahead, Anna, to the next one. So looking at this page for KYC as a focus, and KYC here is in the holistic sense of KYC. It's knowing your customer and CIP and onboarding and watch list recurring and basic due diligence, et cetera. All of our 91% of our customers said that the customer risk assessments and KYC processes have been a significant challenge in COVID-19. Well, shocker there. you're not meeting anybody in a branch. Let's just take the most basic proposition of retail banking. We used to rely on tens of thousands of individuals on the front line of branches. And this applies to money services business, and it also applies to the admin functions of funds and credit unions and other things. We rely on individuals to come in, look at a driver's license or a passport, make a copy or enter the information to the system, probably better for data privacy purposes. But they're the gatekeeper to the truthfulness of that document. Was that ever a good model? Well, those that had already moved to electronic means of, leveraging more verification processes that are automated, et cetera, probably experienced a better outcome when things went full remote and they lost all those front end customer facing staff, because they already had an idea on how they would process identities online. They're remote, no face to face. So clearly there's challenges there. Every iteration with a customer is more painful. There's no branch to bring documents to. There's no office to stop into. Just obtaining documents, or even finding times to communicate, because people are working irregular hours. They're not in their offices. Their contact information has changed. People have lost jobs. And these are all things that impacted it. And if you go on the right-hand side, you can see the percentage ranking, all right, of compliance process challenges and, KYC, delay in onboarding clients. 41% said huge impact to delays and causing delays in onboarding new clients. You know what, folks, again, unfortunately, the whole industry had a lot of delays and backlogs around COVID, but guess what? The people that had less delay actually made more money. They processed more loans, they distributed more benefits, they opened more new accounts. So again, a truism that doesn't need challenge. Lower customer friction and better customer satisfaction, be they a individual or a global corporation, is better for business. So again, I encourage everyone to take away the learnings of this to say, if there's another pandemic, if this one continues, or maybe just because it's good business, what are the processes we can implement to take more of the human touch out of the string? And it doesn't say you get rid of the need for humans. It means that humans are freed up to do tasks that are more productive than trying to figure out if a driver's license is fake or real or typing the info in. Just a suggestion. All right, let's go on to the next page, Anna. Time check on right now, it's 1:28. I do see that a couple folks have raised their hand. If you could throw your question into the Q&A queue, that would be fantastic. That would help me to be able to look at those questions and figure out which ones we need to address in live Q&A and which ones we can address after the fact. And I'll pause again after this slide. So U.S. and financial institutions being the focus of the study here again. This one is about the percent expecting COVID-19 to increase financial crime spending over the next 12 to 24 months. Bear in mind, the survey was taken in August of 2020, right in the middle of COVID. They're saying now how they feel COVID will continue to drive cost. All right, and down at the bottom there, you can see that the percent expecting cost to continue to increase is the majority. All right. The majority in Canada, the majority in the US. Interestingly, an inversion between the small and the medium large. So on the left, the under 10 billions, they say on Canada, they're saying 90% of them are saying it's going to increase. In the US, it's actually on the big bank side that's saying it, but the results there are fairly flat. At the bottom, though, is the expected percent increase, and the percent increase likely to involve technology. Now, maybe this is a good thing because maybe people are realizing, let's stop throwing bodies and processes at problems, and let's find out ways to use technology smartly, the right technology, the right data in the right places. But what this does forecast is that costs will increase again in a paucity of resource scenario. We should be looking at ways to save our organizations unnecessary cost. And again, drive those costs towards teed up, effective, actionable intelligence authoritative and decisive decision-making, and accurate risk identification. We have to identify those things better, faster, and at lesser cost. Part of the way to do that is probably going to be leveraging technology smartly. So let's, Anna, we're going to pause right there for a second. Don't go to the next one. Let me just see if anything has come up. Some of the questions that have come up so far ask about sustainable, how sustainable increased productivity would be. Another one, asked about the very large percentage increases in certain segments of the industry that we've found. But the one I'm going to ask right now, one of the questions was, what are some of the ways that financial institutions are managing their cost obligations while at the same time screening and tracking obligations effectively during current times, using more automation technology? Well, we've touched on that, but let me just give you an example. Let me give you an example of that one there. We saw many players in the market that were engaged in PPP lending underwriting and issuance that suddenly realized that they could cut their cycle time for underwriting and required CIP, Patriot Act, due diligence, and onboarding activities very significantly by combining initial verification of individuals and businesses as in conformance with the CDD rules, in conformance with CIP requirements, by bringing together identity verification, watch list screening, and business verification, as well as fraud risk indicators, all into one process, because they found very quickly that there were certain outliers. This was what actually a troubling response. We actually found a lot of companies said some of the fraud just fell out immediately. There was so much that it actually fell out immediately, meaning people were claiming addresses for businesses that weren't real. They were claiming associations with businesses that didn't exist. They were claiming businesses that had no active registration. Now, folks, if you can cut those off at the door in an automated process and then have people handling them with the required regulatory filings in short order, not after an underwriter or a business line person has spent 40 hours working on the papers, working on the loan. It needs to happen at the door. So the recommendation there is to find ways to combine your processes as to business risk, business verification, identity verification, and CIP as much as possible into your first sets of queries, because that will cut you significant time. Why would you want to invest underwriting time on a package that is patently fraudulent? This epidemic has shown that that is something that has to be done because of the amount of fraud in those stimulus programs. So if we can move on, Anna, we'll go to slide 15. It's 1:33. We're better than halfway done. Quick note again to thank everybody for sticking with it. We've got a very large audience. I look forward to any follow-ups. I do miss speaking to everyone directly. So as for now, this is as close as we get, but I look forward to us returning to more in person soon. So if I could, on the next slide, key finding number 3. This one, as I mentioned earlier, is about screening, risk profiling, due diligence times are big challenges. In COVID and in general, they're still big challenges. E-commerce, retail, and services segments like real estate and legal industries are key segments where these activities are causing problems. Respondents in those areas continue to highlight the burden upon them. E-commerce, particularly following a couple of very prominent enforcements, or a number of prominent enforcements over the last several years, where OFAC has refocused from the financial institution side to the commercial side. E-commerce got lit ablaze by the COVID epidemic and suddenly had to act to protect their marks, their brands, their trademarks, their names at volumes not seen before. While some sectors like travel, entertainment suffered greatly, others like e-commerce for consumer goods surged. And everyone that touched that process had to react more quickly. So those were challenges. I mean, this is a space where we routinely see requests to fill high volume, millisecond respond times for screening, for identification, for verification. So a very challenging space. Obviously, it's taking longer to conduct due diligence, to resolve alerts in some cases, to resolve screening outputs, to resolve other things. Part of that, again, is data. And just I want to drive it different. We have a very significant number of attendees today who are from e-commerce and from the business side that's not in regulated financial services spaces. What we share across those industries, the business non-regulated FS side, non-FS side, and the financial services regulated side, the biggest point of commonality is sanctions, as we all know, because we're all at equal risk of enforcement. Now, obviously, banks and regulated financial services entities have more introspection from on-site regulators and auditors, but both entities suffer greatly for sanctions. We have to look at that regime and figure out how to do it well to protect us from sanctions risk. But let's take a step back again and say the goal of the sanctions regime is to affect change, whether it's human rights, nuclear proliferation, or other reasons, using economic means. So it only works when you actually identify a sanctioned entity. Let's just think about that for a second. If you are slowing down customers repeatedly who have like names, like addresses, like attributes to individuals who are sanctioned, but don't ever turn out to be sanctioned, we're wasting our time. We're wasting our time and we're not achieving the goal of the regime. So I just ask everybody to kind of sit back and say, how do we look to reinvent this space to identify true sanctions risk? Whether you're in e-commerce or whether you're in regulated financial services, we all fear a sanctions enforcement. So we have processes in place that may not be working the best we can. When we find true sanctions risk, are we sharing it in consortia? Nope. Are we sharing it in a live and dynamic environment that protects privacy, but also speeds the ability to stop sanctioned actors moving funds around the world? No, we're not. We're still screening a lot of names, but I'm wondering if we're actually accomplishing the goals of that regime. So take that one away and think about it, and think about how COVID has affected it. And if you go ahead to the next screen, I'll stop pontificating and get back into the findings here. On this page, what we talk about is what I've mentioned about e-commerce and these specialized sectors. You know, these are responses from all of our respondents citing their level of concern for these segments. Now, interestingly, some folks may remember prior years where we focused on, you know, non-bank financial entities, non-bank regulated entities moving funds, and how banks viewed the risk of interacting with those entities. This one was focused on what kind of risk do we see for financial crime in e-commerce, retail, real estate, and legal. And again, probably not a huge shocker here. Most folks in both the US and Canada responded they found heightened risk above the median for all those entities. The one that really stands out is e-commerce. So again, I ask you to think about and challenge the shared risk here. If you're in e-commerce, nobody in e-commerce wants to sell controlled goods when the cost and enforcement reaction is billions of dollars in fines, penalties. In fact, the dissolution of some companies in recent enforcement actions. So let's figure out ways to better identify true sanctions risk in e-commerce, because you can't do e-commerce without touching somebody else on the phone who's from an MSB, a payments provider, a bank, a fund, etc. They're intrinsically linked and the risk goes back and forth. So we need to look at how we do that better. Let's keep going, Anna, to the next page, because people can digest a little bit more of this, and in the interest of time, we're heading up on 140. This one breaks down the actual rise in the change in how people ranked challenges for specific types of financial crime compliance activities. You'll see that we have sanction screening on the left, all the way over to identification of PEPs on the right. And again, it's this one, the dark blue is Canada, the light blue is the US. And the 2019 numbers are down below. Now, why have I been harping on sanction screening so much? Well, because our respondents said This is a pain in the butt, and it's getting worse. 2020 didn't get better for sanctions screening. It got worse. So if that one you look at, on Canada, they said they went from 51% saying this was a key challenge to 59%. In the US, it went from 49 to 63, a 14% increase. That's huge. Why is sanctions compliance getting harder? Again, maybe we need to look at our tools, our processes, our reference data sets, and the outcomes from them. Everyone in the industry says it's getting harder. And the question is, are we catching more sanctions violations? I'm not sure we are. Now, all the way on the right, you look at positive ID of PEPs. This one's interesting to me because, as most people know, Canada is one of the most PEP regulated spaces in the world. They have very definitive and elaborated requirements around politically exposed persons, including a requirement for persons at a very local level to be identified. They shot from 30% up to 40%, a 33% increase year over year just in Canada in how many of them said PEP's a problem. That one's interesting because not much has changed in regulation except for the requirement for those local PEPs to be included. So the question there is that the driver? You might think it is, except for the US also went up by 10 percentage points for that same period. So the big ones here, as you look across, sanction screening, customer risk rating or risk profiling, PEP identification, and then the general catch-all of KYC onboarding, all showing stark increases in both the US and Canada. So let's go to the next page. Yeah. On the next page, we're going to talk about how the challenges are negatively impacting productivity. I always love this point in the survey. When we get to this part, when we get the readout from the firm that we use, I'm always excited to see what people are saying, because this is where they start talking about how has something, just year over year or a special event like COVID. In this case, it's just what are the things, how much are things like financial crime compliance processes affecting productivity, customer acquisition, and later we'll get to some other things on the next pages. I love this section because it shows you where things are painful. And as a vendor in this space, we look to try to react to that. On this page, as you look at it, you can see, again, Canada on the left, US on the right, in each of the charts. On the left, it's about productivity. On the right, it's about new customer acquisition. And you can include in acquisition, obviously, onboarding as well. The one to look for is the dark section. The dark section is negative. That is offset by the light blue section, which is, hey, there's been a positive impact. The financial crime compliance processes have actually positively impacted. And what you see there is that Canada and the US are very closely aligned as far as their belief of the impact of financial crime compliance processes on productivity. Now, on the right, for new customer acquisition, what is shocking there is what they're saying is on the left in productivity, financial crime, it's like, it impacts it, it's necessary, it's not so bad. There's a clear statement on the right that when it comes to new customer acquisition and onboarding, financial crime compliance processes stink. They are negatively impacting the business. Folks, somebody that I have a lot of respect for said to me recently, I think sometimes we need to be reminded that the business of banking isn't compliance, it's about moving money. And it's about banking. Now, that said, I had to counter with, of course, we want to do it responsibly, we want to protect the system, but sometimes we forget that the business that we're all in is to make money, and that compliance, when it poses too big a challenge or burden to that, is not going to have good outcomes. Well, look on the right, folks, we're not having good outcomes. Our onboarding and acquisition processes for new customers have tremendous friction built in. There is no way our businesses like that impression at all. So we have to figure out ways. And again, COVID may have been a driver that changed this year's responses, but that's a frightening number saying that there's huge friction in onboarding. If we can go ahead and to the next page. And after this section, I will again pause. So here we've got alert volumes, right? And where people believe alert volumes will continue to go. Now, this one's interesting because you can cut it a lot of different ways. Is the segment growing? So if you grow more in your base, are you going to do more screening? Well, this is just folks, just to take it back a step, this is just about if you ask decision makers, hey, where are your alert volumes going to go? Now, at the most basic level, we should all be looking for fewer alerts. We should be looking to find ways to more accurately identify true risk. And if right now, watch list runs in the 60 to 90+% range, and transaction monitoring runs in the like 80s and 90% false positives, and you can debate that, but anything above 10% is bad. And we're nowhere near that. So shockingly, the respondents to our survey in Canada said 90% said we're seeing an increase. 82% in 2020 said we're going to see an increase. Still far too many people saying there's going to be an increase, and the percentage that they expect actually went up. So in 2019, they said we're going to go up 12%. In 2020, they said we're going to go up 18%. In the US, similar trend. Asked in 2019 in the survey, they said 11% volume increase in the lower hand corner. In 2020, they said we expect the volumes to increase by 18. Why are we still tolerant of rising percentages? We, like others in this space, LexisNexis Risk Solutions is working like others in this space to find better ways to do things. There is no one perfect space, but I hold great hope for the combined activities of alert, false positive reduction efforts through AI and machine learning, through better data. Part of that is data internally. I'm just blown away by how many customers will come to you and say, our dates of birth are messed up. We've got European format and some of the bank, and US format and others. We have no dates of birth here. You got to clean that up. You got to clean up your data. You got to practice some data hygiene, and then you've got to move ahead and try to screen better. Because folks, just the bottom line here, it's screening at this velocity and volume is not sustainable. We've got to find better ways to do things. And I call us all to work together to say, how do we work with government and regulators to more accurately identify risk, to reduce cost increases, absolutely, so that our money is spent on finding financial criminal and illicit financiers. Let's go ahead, Anna, to the next page. So before I go into key finding number 4, I'm going to take a look back at the Q&A segment right now, which I actually just lost. There it is. Again, thank you for the number of questions. We've got a significant number of open questions. Some of them were actually asked and answered already, but one I want to address. There was a mention of number of hours spent on a single investigation, or whether it was a different metric. Time spent on investigations is simply an arbitrary number. A good friend in the industry recently used our study as the baseline to make some extrapolations and said, hey, if folks are estimating it takes X number of hours per investigation, that means there's an enormous amount of wasted effort. No matter which way you cut it or extrapolate it, if people believe that if decision makers believe it takes multiple hours to decision an alert or have an investigative outcome be finalized, that's too long. Because the real cases take significantly longer, and the cases that shouldn't be investigated should take significantly less. That average should be consistently dropping. Again, we want to focus our efforts on the important large-scale efforts. And to the person that asked that question about was that number of hours per case, we're going to see another piece come up on that. And if we don't answer, I'll even go back at the end. It's 1:49. We got 11 minutes left. Let's talk about key finding number 4. How much are you giving thought to how financial crime processes benefit the larger organization? So when you think about risk assessment and onboarding, assessment of attributes, with careful eye to privacy and credit laws in your jurisdictions, there are a lot of ways to leverage that data to enhance your business proposition, to get people the right products, to accurately segment them, to identify those that are private bank eligible from those who are not, to those that should be targeted with certain lending products, to those that are not. Because the same things that identify aberrant behavior, the processes that identify aberrant behavior, things which are typically cause you to have suspicion, requires a knowledge of attributes to begin with. If you don't truly know your customer, how do you know when your customer acts atypically and when that actually is worthy of suspicion? If they claim to be in this occupation, living in this area, if you don't understand how that person operates, how do you know when they've strayed from the norm? That same information collection benefits your entity, whether it's a fund, a credit union, a bank, a money services business, or other. The more you know, the better you serve. So let's go ahead on this page here, Anna, to the next one. On this one here, we actually have more info about how information collected on the customer can help the relationship with risk management and other areas. So we asked respondents, like, which are areas, and we gave them some suggestions, which are areas where you believe your compliance processes and the intimate knowledge of the customer that's developed can help your business. And this is where they answered. It's ordered pretty much on a sliding scale from the highest on the left to the lowest on the right. And on the left, improved data for customer relations. Next one is improved data for risk management. The next one is improved understanding for customers. No shocker. The least cited one is on the right, which is STP. Like, how do we reduce STP exceptions, straight through processing exceptions, which are just simply the bane of the industry, folks. Like, and if you think about STP in payments and cash settlement, that's one way to look at STP. But we should be looking at straight through processing of everything from onboarding to new account opening to wire ordering and settlement. It was cited the least, but I think it's an incredibly vexing problem. Compliance, think about this. When you talk to people in the global payments and global cash management treasury areas to say what inhibits the ability of people to move money around the world, and remember, our companies are about moving value, moving goods, moving money. They're not about compliance. Compliance is an adjunct, and can you be a helpful adjunct to your business? Well, that's straight through processing on the right-hand side. When you ask people what stops money from moving, number one answer, human error. Second answer, compliance. Sometimes those two are inverted. Number one answer, compliance. Number two answer, human error. So whether people miskey or fat finger an entry, or whether it's compliance that finds a name that's too close to a one of concern, we are slowing down the movement of money globally. Going back to what I mentioned about sanctions, the sad thing is, the vast majority of those shouldn't have been stopped. So I would say, take a look at the right here and think about how more knowledge of your customer and how sharing that information globally should drive better straight-through processing. Meaning, if you're moving money from one bank to another, the more each bank knows about the person and the more information they share in carefully guarded and protected consortia, the faster that money can move, the fewer times the guy with the unfortunate name that's too much like one on the OFAC list has his funds unnecessarily held up by every one of the four banks in the correspondent string. Folks, that should be a very unpleasant thing, because if it hasn't happened to you, at some point in your life, it'll happen to somebody in your family or a business you're associated with, because they're buying Persian rugs and somebody wants to stop the payment. Well, maybe you should, maybe you shouldn't, but you better have a rational decision around that. Maybe it's a city named Sudan, Ohio or something. It's going to stop your payment. It's going to freeze you up, and you're not the bad guy. So folks, let's find a better way to do it. On the left-hand side, it starts with the data proposition on this page. I can't believe how many people in our industry still say they have data that is not normalized, that is irregular, is known to be untrue. How many customers say they have vast segments of their portfolio, either acquired through merger, acquisition, or they were pre-CIP rule, pre-Patriot Act records? You're still sitting on records with bad and deficient core data? Do you know what that does to your screening process? It's bad enough having to screen against an alias of El Gordo or Mohammed, okay? It's bad enough. But if you have to do that against core data that lacks accurate dates of birth, addresses, and full information around names and citizenship, et cetera, you're going to have bad query outcomes, CIP outcomes, watchlist screening, investigative, et cetera. So just take a look at this later. We're getting close to time. We're about 6 minutes from the end, but from the left is the most cited, to the right is the least cited. None of these are unimportant. You should be looking at ways to take these themes and come back and say, how can my compliance process lead to better outcomes? Maybe it starts with data, and the data we collect. And if I collect more data, make it not just compliance. Make it about your business, about knowing your customer better. Let's go on to the next page, Anna. Key finding number 5, and actually I'm on track, shockingly. I'm sure the team will be quite shocked to see we're on track to finish on time. Key finding number 5, if you've invested in technology smartly, you likely fared better under COVID-19. And this is frequently the wrap up to our study, but again, I'm not trying to say it's one technology, it's not one vendor, it's not one data source. You've got to find the right one for your entity, for the business you operate in, for the volumes you feed, for the tempo at which you operate. You've got to find the right solutions and the right data. So grab your account representatives by the neck and say, how do I get the right one? Let me tell you my problems. Let me tell you what causes me pain. How can we be helped? And let's work collaboratively to find better. Because again, we're not just an industry where people are selling stuff to others to buy, to do work, to generate widgets. When you stop somebody's money and they're not a bad guy, it hurts them. When we fail to stop a bad guy's money moving, we've missed. So we've got a pretty high calling to act together to find better processes and technologies to more accurately identify the bad. So let's go ahead to the next page, Anna, and talk quickly about how people have leveraged technology well. And similar to prior years, still a challenge. Technology is still critical, but what's interesting is despite COVID, and despite the effects of that, as outlined on previous pages, those that had leveraged technology and technology processes in a thoughtful manner found that their increases were less. Their proportionate 2020 compliance increases were less. So on the left-hand side, in the light blue bar, when you see those that allocate less than 35%, their cost was 23.7 on average. On the right, if you allocate more than 50%, it's 18.7. And again, I'm not saying wantonly spend on the technology. You have to find the right ones. But when you find the right ones, it should be a lift. There should be an collectively amongst your staff who say it's working better. There should be a collective from the front end of the business who comes back and says, you guys are great, because now I waste half the time I used to in non-customer facing activities. That's what you want. It serves everybody better. On the right-hand side, it talks about fewer negative impacts from COVID-19, again, through the lens of technology. And it breaks it down in the same way we did in the left-hand bar chart. Those that spend less than 35%, those that spend more than 50%. And there is a marked difference. The most shocking of them up in the top there, okay? KYC onboarding and customer risk rating or customer risk profiling. Those that spent less almost double the significance of negative impact, the citation of it being a significant negative impact to their processes. So I ask you again to go back and say, take the time from this lessons, from this pandemic, and say, how can we do it better? How can we face the next challenges, create a better experience? You can go on to the next page, Anna. So what are the implications of this? It's 1:58. We've got 2 minutes left. I'm going to rapidly move through this and just say, folks, COVID's going to continue. We've got to continue to be expecting increased financial crime burdens and the potential of spend, but let's figure out how to contain wanton cost rise, leverage technology properly, and come back to our businesses with a better proposition on cost containment, resource utilization, but really let's embed that whole message with how do we catch people that are doing bad things more effectively. The second column here talks about skilled compliance professionals and the effects of all these things on them. Folks, it's very clear that as people work in this space, if they are faced with rote, non-productive processes, bad data, and outcomes that don't lead to enforcement or the stopping of illicit activities, they get disheartened, they walk away. And we pay people well in this space. Let's give them the tools and the processes that let them make good decisions. We've got to have good data, and you definitely